K Joshi, Director and Chief Economist with CRISIL also joins us. Mr. Joshi, good afternoon and thank you for joining us. We may call it Lady Luck or God's will, but for the moment it appears that Indian macros have topped out. I mean, things are looking favorable.
Well, I think they do look favorable. I think the biggest advantage, as was being pointed out, is from the lower oil prices, because I think oil benefits us fiscally, it benefits us from the inflation point of view and also from the current account deficit point of view. So low oil prices, India is one of the most vulnerable economies in the Asia-Pacific region as far as oil is concerned. So I think, we benefit a lot when the oil prices come down, and I think that benefit is going to be visible definitely this year. And it also actually will reduce the cost of production for at least for those industries which use oil as a primary input. So I think overall, yeah, things are improving. Even the initial hit from the monsoons has somewhat faded after I think the rains picked up. There is going to be damage to agriculture in the Kharif season, but the Rabi would look good because the soil moisture is good, and also because the reservoir levels are quite they are almost 104% of their 10-year average. So overall, I think things are looking reasonably better right now. But I think GDP pickup will not be very swift. It will be very mild, and we expect the economy to log around 5.5% growth this fiscal.
Dr. Joshi, you did say that things are looking up, things are much better than what we had envisaged earlier. But if you look externally, if you look at the US Fed, are all the worries on the US Fed action, are they completely set at rest? Or what is your interpretation of considerable time? How do you read it? As 6 months, 8 months, 9 months? And the Fed has already said that when they start reversing, interest rates will start moving up much faster than before. So two questions for you. One, what does considerable time mean as far as you understand it? And would you agree with the Fed's timetable in terms of higher interest rate by end of 2015?
Well, I think Fed has also clearly stated at the same time that it will be, their actions will not be calendar driven but be data driven. So I think the US economy data is turning positive, but it has, I think we've seen its own surprises over the last couple of months. So I mean, I would wait for data to pan out, and then I think that is what will decide what the Fed is going to do. But I think as of now, it looks like the tapering will end by October, and the consensus seems to be emerging that by middle of next year or maybe a little after that, I think we could see interest rate hikes. But I think, as I said, it will all depend on the strength of the data. World economy is improving, but still I think there are worries. Particularly, there is a fear of triple dip recession in Europe, which will require very aggressive monetary easing there. And the Asian economies are also, I think particularly China, might manage to scrape through 7.5% growth this year. So I think overall the only strong engine appears to be U.S. economy at this juncture, but I think as I said, what kind of data we get in the coming quarters will decide what the Fed is going to do. And right now, I think things look that U.S. will deliver around 2% growth this calendar year.
Yes, certainly data is king, but would you agree with the opinion expressed by one of the brokerages that amongst the developing and emerging markets, if you look at Fed, any reversal of flows as and when the Fed reverses interest rates, it is India and Philippines that seem to be the strongest place to deal with any kind of reversal. Would you agree with that assessment?
I would agree, because I think our vulnerability is quite low right now. The current account deficit as a percentage of GDP is very much within control, and I think that's going to benefit from softer commodity prices and also softer oil prices. So I think there's not much risk on the current account deficit front. And also, as we were talking, the domestic macros have improved. The sentiment is very strong as far as India is concerned. We've got huge amount of capital inflows this year. compared to what we got last year, and the economy is also beginning to slowly but steadily pick up. So I think the pull factor has improved, and also I think our vulnerability has reduced. So I think we'll withstand the crisis much better than last year when the rupee started plunging. So I think yes, I think from the vulnerability point of view, we are definitely much better positioned to face the reversal of interest rate cycle in the West, in the US particularly.
And are you hearing any rumblings in the market about the RBI's interest rate policy? And if so, what kind of action do you expect the governor to take on the 30th of this month? Is there any pressure building on him to cut interest rates? What is your sense out there?
Well, I think the inflation is still a worry, though WPI inflation has come down to a 5-year low, but the CPI inflation, which is the preferred gauge for RBI, still is close to 8%, and their target is for next year is 6%, so they'll need to remain vigilant, and I don't see any interest rate cuts this year.
And what is your assessment of the G20 meet? Has the G20 lost its relevance? Australia is talking about raising global GDP by 2%. Is that very optimistic an estimate, or you think it's feasible? Is it possible at all, or is the G20 a completely redundant organization now? Is it more like a talking shop?
No, well, I think they are raising pertinent issues, and I think the raising by GDP by 2% by 2018, I think that's a tall order given the state of the world economy, and I think they also admit that this kind of growth is required if you want to generate enough jobs in the western part of the world or throughout the world, and it's a stiff target to meet, and I think a lot will depend on how the financial conditions, what kind of steps the European economies take to revive the economy. So I think a lot is fluid right now. It's a very stiff target, I would say.
Maithili, I would just like to come to you with, a bit of a concern that we've been discussing with a lot of our market experts as well with respect to the US hiking interest rates. And of course, it is inevitable now. It's more of a timing of when it's going to happen. And you do have certain reports, which we discussed the last time around, saying that India is better positioned when the US rates rise. What's your overall assessment of the same?
Well, we're definitely better positioned, but it's all a question of relative. We are better positioned than we were last year in May, June, July, when actually we did take a very severe hitting. But it's also a question of the assessment of the market. We are better than before, but we're really not completely out of the woods. Because if you look at our CAD, it has been artificially compressed because of administrative measures on gold imports. If and when these measures are removed, gold imports are bound to surge unless we get inflation dramatically under control. On the growth front, we're still not out of the woods as yet. Inflation, yes, better than before. So I would say, if I were to put it in a nutshell, we're relatively better than before, but we're not out of the woods as yet. So it all depends on what the external world's view of India's strength is. We're better than many of the BRIC countries, but are we as good as China? No, we're not. So I think we'll have to wait and see and play our cards very, very carefully.
Okay, Maithili, along with Mr. Joshi, thank you so much for taking time out and giving us your views on the macros and telling us what you make of it. And the reason we spoke about the US interest rates in India being better positions is because Fitch came out with a report on